Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Wednesday, February 25th, 2026. Let's look at the tape today, because the numbers are telling a very specific story. Starbucks Corporation closes at $97.93. That is up 1.47% on the session. We saw a daily high of $98.20 and a low of $95.90, with volume clocking in at 211,745 shares traded.
A green day and a pretty red tape. Sure.
Right, it is more than just a green day if you zoom out a bit. We are coming off a 5-year period where Starbucks fell 7%, while the S&P 500 rallied 80%. That is a massive underperformance, but now we are looking at a stock that is up nearly 15% year-to-date here in early 2026. The question we are debating today isn't just about today's close. It's about whether this recent price action represents a true structural breakout driven by CEO Brian Niccol's back to Starbucks plan, or if the market is frankly getting way ahead of itself. I am arguing that the operational turnaround is genuine, evidenced by a return to transaction-led growth and massive institutional conviction.
And I am looking at that exact same chart and seeing a trap. I mean, while the momentum is undeniable, I won't argue against the tape. I am looking at a valuation that is completely detached from reality. We are trading at a PE ratio of roughly 77 times earnings. That is priced for absolute perfection in a chaotic macro environment. Between the really messy financials of the China divestiture and the lingering tariff risks that the market seems to be willfully ignoring, I argue that the risk-reward profile at $98 is skewed heavily to the downside. You are paying a premium for a turnaround that just hasn't actually finished turning yet.
I think you are getting hung up on the trailing multiple, which we both know is distorted right now. But let's get right into the bull case, because the market is telling us something fundamentally changed in Q1 2026. If you look at the volume spike on January 28th, that was over 1 million shares traded. That was the pivot point. That was the market digesting the earnings release. And why? Because for the first time in 8 quarters, Starbucks achieved transaction-led growth.
Transaction-led being the key phrase there.
It is the only phrase that matters right now. For 2 years, their revenue growth was an illusion. It was just ticket inflation. They were raising prices on fewer and fewer customers. Q1 2026 broke that trend. This is more people actually walking through the door. This is the green apron service model actually working. We saw the data from the 650-store pilot. They showed a 200 basis point outperformance in comparable sales relative to the rest of the fleet. They got service times under 4 minutes during peak morning hours. That is the absolute holy grail of quick service restaurants: throughput. If you can move the line, you move the stock.
I want to pause on the holy grail narrative because, well, I think you are extrapolating a pilot to the whole fleet a bit too optimistically. But before we get to the store-level operations, have you considered the price of admission for this stock right now? You mentioned institutional buying earlier, implying the smart money is all in, but you left out a key seller. Nelson Peltz and Tryon Fund sold their entire position back in August. Peltz is one of the shrewdest consumer activists in the game, and he explicitly said the easy money had been made.
He sold before the confirmation of the pilot's success, though. He missed the validation of the strategy.
Or he sold because he can do math. Fast forward to today, and we are sitting at a PE of 77.51. For a company targeting at best mid-single-digit revenue growth, that multiple is astronomical. It's priced like a high-growth AI semiconductor stock, not a mature coffee retailer facing global headwinds. If you buy here, you are betting that every single part of the Niccol plan executes flawlessly. There is zero margin of safety at $98.
I think you're focusing too much on the trailing 12 months PE, which is, again, heavily distorted by the tax situation. And you're ignoring the forward guidance. The smart money isn't looking at last year's accounting noise. T. Rowe Price increased their stake by 65.9% in the most recent quarter. Norges Bank entered with a $1.2 billion position. These are conservative, long-term allocators. They aren't chasing a meme stock. They are betting that the back to Starbucks plan is a structural fix, not a temporary bump.
They see the return to the third-place philosophy as a value driver that the algorithms are just missing.
But we have to look at the quality of the earnings that generate that PE. The financials this past quarter were incredibly messy. The classification of the China joint venture as held for sale triggered a tax rate spike to 61.7%. That crushed GAAP EPS. You can call it a one-time event, but it complicates the valuation picture significantly. And looking at the options market, implied volatility is sitting at 39%, while trailing volatility is only 34%. The derivatives market is actively bracing for execution errors. The yield-bow strategies we are seeing on the $77 strike put suggest investors are only comfortable owning this if they can get a massive discount. That doesn't sound like high conviction to me. That sounds like hedging against a crash.
I'm just not convinced by the derivatives argument because hedgers always hedge, especially after a 15% run-up. Let's dig into the operational reality instead, specifically that green apron model you brushed past earlier. The core debate here is whether they can fix the store experience. The Smart Queue algorithm and the renewed focus on eyes-up hospitality are actually working in the stores. They are rolling out the Mistrena 3 espresso machines, which allows for speed without sacrificing beverage quality. This justifies the premium valuation because they are reclaiming that core third-place identity. If they fix the throughput problem, the earnings will catch up to the multiple very quickly. The pilot data proves the concept works. Now it's just an execution game.
Just an execution game? I'm sorry, but there is a fundamental contradiction in that strategy that I cannot look past. Management is trying to execute a $2 billion efficiency push, cutting costs across the board, while simultaneously increasing staffing levels to deliver that eyes-up hospitality. You cannot cut your way to better service while paying for more labor hours. It's an operational oxymoron. Where exactly is that $2 billion coming from if you are putting more bodies behind the counter?
It sounds like a contradiction only if you assume the cuts are coming from the store level. They aren't. The $2 billion in savings isn't coming from slashing baristas, it's coming from the efficiency agenda in procurement and organizational streamlining. Consolidated general and administrative expenses, G&A, were already down 7% in Q1. That is corporate bloat being cut, not store labor. They are reinvesting those headquarters savings straight into the front line. It's actually a textbook turnaround strategy. Cut the fat at the top to build muscle in the stores.
Even if I grant you the G&A cuts, look at the menu strategy. They are pushing the afternoon reset incredibly hard. Energy refreshers, protein drinks, ube-flavored beverages. They are chasing a crowded market segment with highly complex menu items. Every time you add a customized protein drink to the line, you slow down that new Mistrena 3 machine you're so excited about. Menu complexity is the absolute enemy of throughput. They are ramping up complexity right when they need speed the most. You can have eyes-up hospitality, or you can have 15-ingredient custom energy drinks, but you usually can't have both under 4 minutes. It creates a bottleneck that no amount of smart queuing algorithms can magically solve.
Innovation is necessary for volume, though. You can't just sell drip coffee and expect transaction growth in 2026. The modern consumer wants customization. But I want to shift to the elephant in the room, or perhaps the dragon, the China joint venture. This is a massive structural change that I believe unlocks the exact value you claim is missing. This is the catalyst that cleans up the balance sheet.
It certainly is a massive change, but not necessarily for the better.
I have to disagree. The deal with Boyu Capital, selling 60% of the China operations, values that business at over $13 billion. It's a classic asset-light move, very similar to what McDonald's did in China years ago. Boyu knows the local real estate, they know the digital ecosystem, WeChat, Alipay, better than executives sitting in Seattle ever could. This is essential for fighting off Luckin Coffee and Cuddy Coffee, who are engaging in a brutal race-to-the-bottom price war. This deal de-risks the Starbucks portfolio significantly. They are handing the keys to someone who actually knows the roads.
De-risking is a polite corporate euphemism for losing control. They are giving up majority control, 60%, in what was supposed to be their fastest-growing market for the next decade. That is a defensive retreat, not an offensive win. And let's talk about the accounting fallout I hinted at earlier.
By classifying the China business as held for sale, they stopped depreciation and amortization on those assets. That artificially lowered operating expenses by $39 million a month.
That is standard accounting practice during a divestiture under GAAP, though. You can't penalize management for following the rules.
It is standard, yes, but it makes the operating income look vastly better than the underlying reality. You have a situation where expenses are artificially suppressed by nearly $40 million a month, and yet the tax hit was very real, driving that effective rate to over 60%. The guidance suggests a dilution of only 2 to 3 cents per share, but I think the loss of direct access to the Chinese consumer data and the reliance on a partner for execution is a very high long-term cost. You are essentially turning your growth engine into a static licensing fee stream. You are capping your upside in the second largest economy in the world.
But it's a stable licensing fee stream. I see why you worry about control, but the dilution is minimal compared to the massive capital intensity they are shedding. They are getting cash up front and a predictable stream of revenue going forward. It stabilizes the earnings volatility, and investors hate volatility. They want predictability. But speaking of volatility, we need to address the macroeconomic environment. You mentioned tariffs earlier, and I know that is a big part of your bear thesis.
Absolutely. We have to talk about tariffs because the landscape shifted dramatically just last week. The Supreme Court ruling on February 20th was a double-edged sword. Yes, they struck down the IEPA tariffs, which were hitting coffee imports hard, but the administration immediately pivoted and slapped a new 15% global tariff under the Trade Act of 1974.
The market knows this, though. This has been in the headlines for days. It's priced in.
Does the market essentially understand the mechanics of it? In Q1, we already saw 420 basis points of margin contraction, partly attributed to product and distribution cost inflation. Now you have a confirmed 15% levy on global imports. Coffee prices are up, distribution costs are up. And here is the kicker: price stickiness. Even if tariffs ease later, consumers are tapped out. If Starbucks keeps raising prices to cover this 15% tariff, they risk killing the very transaction growth they just got back. You can't pass a 15% hike onto a customer who is already paying $7 for a latte. That is a fair concern regarding consumer elasticity, but I would argue the market has priced this in. The stock held the $96 support level firmly despite the headline risk of the Trade Act tariffs. Why? Because the margin contraction is viewed as temporary. More importantly, the new rewards program launching March 10th is the buffer.
The rewards program? How does a loyalty app solve a 15% global tariff on green coffee beans? Because it changes the value equation without destroying the brand equity. The new tiered system, Green, Gold, Reserve, allows them to offer value to price-sensitive customers without doing blanket discounting. They have 35.5 million active members. For the first time in 8 quarters, both rewards and non-rewards transactions grew simultaneously. This proves they don't need to slash prices to drive traffic. They just need to offer better perceived value through the tiering. It allows them to absorb some tariff pain without passing 100% of it to the consumer immediately. It is essentially targeted discounting rather than broad-based margin erosion. They can surgically target the price-sensitive customer while keeping the premium margins intact for the rest.
I remain skeptical that a tiered reward system can outrun macro headwinds of that magnitude. You are asking an app to do a lot of heavy lifting against geopolitical trade policy. But let's look at the technicals, since you seem confident in the floor. You mentioned the stock holding $96.
Correct. We have strong support at $96.24 and $96.43. The technicals are flashing buy signals on both short and long-term moving averages. The retracement we saw in early February, that dip, was a healthy pullback, not a reversal. It shook out the weekends. If you look at the chart, we are making higher lows. That is bullish behavior.
A pivot top sell signal was issued on February 6th. We are trading in a range, effectively. The daily high and lows show indecision. And coming back to the options market, that interest in yield boost strategies suggests that the smart money, the real smart money, the hedgers, doesn't see this breaking out past $100 anytime soon. They are capping their upside. They are selling calls against their position because they don't believe in the breakout. They're happy to collect the premium and sit sideways.
Or they are generating income while they wait for the long-term thesis to play out. The fact that the stock is up 15% year-to-date while the broader narrative is so intensely focused on risks tells me the path of least resistance is higher. The $2 billion efficiency push is real. The G&A cuts are ahead of schedule. The story's holding up much better than the sentiment suggests.
But is the Back to Starbucks plan truly resonating, or is it just a catchy slogan? The pilot showed success in 650 stores. Scaling that to the entire North American fleet requires a level of execution consistency that we haven't seen from them in years. And doing it while cutting corporate costs is the definition of walking a tightrope. One slip on the efficiency side, and the lines get longer, the stores get dirty, and that hard-won transaction growth evaporates. It's fragile.
Brian Niccol has done this before at Chipotle. The strategy is sound. Improve the product, improve the speed, and the customer's return. The data from Q1, specifically that massive volume spike and the transaction growth, is the early evidence that it is working.
Let's wrap this up because I think we are looking at the exact same numbers and seeing two very different movies. For me, while Back to Starbucks is a nice sentiment, the math is precarious. You have a 77 times PE ratio, a highly confusing tax situation from the China deal, and a macro environment defined by new global tariffs. The stock is near $98, basically sitting in the middle of its 52-week range. I think the upside is securely capped and the execution risks are remarkably high.
And I see a company that has finally stopped the bleeding. The technicals, the higher lows, the buy signals match the fundamental shift back to transaction growth. The China joint venture closure in spring 2026 will clean up the books and remove that constant overhang. The conservative smart money, like BlackRock and T. Rowe Price, are voting with their wallets. They are betting on long-term execution, not just current year math.
Well, we can certainly agree that the critical milestone to watch is that China deal closing in the spring. That is the moment the accounting noise clears and we see the real earnings power of the core business.
Agreed. That, and whether the Green Apron service times actually hold up as volume increases into the summer. There is definitely plenty more to explore in this material as the year unfolds.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.